Okay, so I've got a model I made here. I've been working on the past couple hours or so, valuing Facebook. It took me a little bit to uh, update the most recent 3 quarters and calculate the free cash flow and whatnot. So the most important thing on this one is, second of all, let me update this. I was working on it a little bit last night as well, and the as you if you've watched any of my other valuation videos, you've seen that I basically I basically get take five measured compounded annual growth rates, CAGRs as I'll call them from now on, and uh, they I kind of look at the min and the max, and then kind of use some qualitative data, just my opinion on this model's for the next 10 years. So I want to stay more towards the conservative side because businesses are so unpredictable, economies are so unpredictable in the next year, let alone 10 years. So that's also where you'll see in cell B12, I have my perpetual growth rate as 2%, conservative as possible, just to try to account for unpredictability. And as you'll see in my last videos, you can always alter this. My discount rate is super conservative, 12%, just because that's if I'm going to invest in a stock, I don't care. I don't try to time the market. I want at least a 12% because that's the average return of the market over the past 80, 90 years or so. So, so let's look at this model a little bit. Um, so here's the five growth rates from net income, op cash flow, free cash flow, earnings before tax, and revenue. I actually like earnings before tax the most because it takes out the what's the word, like variability of the taxes that a company will pay, and I really like to use it for that growth rate. Don't value the company on earnings before tax, but value them on that growth rate for their net income, because net income is really what I care about when it comes down to it. I don't value a company by dividends because I assume that if the company wanted to, they could pay all earnings out as dividends and still be a going concern. So, free cash flow is a little bit low relative to it's still really high, but relative to its other growth rates, you'll see free cash flow at 28.4% over the past 5 years. It's gone from 7 billion to 21 billion. And this year, it's actually my projection for this year. I don't have fourth quarter information yet, of course, but I projected it as 18 billion, close to 19. So it might even go down a little bit this year, but everything else looks pretty good. See operating cash flow. I don't know. We're gonna need a revenue's looking great, but we're just gonna need some more operating cash flows. Basically, what cash flow is basically what it's coming down to now when it comes to getting our free cash flow, because our capex is pretty good this year. It's lower than it has been the past last year, and then adjusted for inflation, probably about equal for the past 3 years, I'd say. So looks like we're just needing some more cash flow. That might be coming from depreciation cost or whatnot. But either way, let's get down to Mike. This is where you might not agree with me, but optimistically for the next 10 years, I have it grouped where you can't see it. Just to save room. But yes, this goes out until 2029, and then I have the terminal value here. Let me minimize that again. And what this basically saying is, worst case scenario, I mean, a new social media comes out, Facebook suffers huge lawsuits, 15%. Worst case scenario, I think they'll still have a 15% growth on their earnings. which is this column right here, net income. And also, best case scenario, I mean, they've got net income growth at 50% the past 5 years. Next 10 years, I think 35%. It could, I'm pretty bullish on Facebook, so I think it could go higher. But just to be conservative, I'm going to go with 35%. I'm always more on the conservative side. And then right here's where I select. Let's say Facebook goes at 50% in the next 10 years. I would say a fair value for them with a 12% discount rate would be $1,660. I'm not saying that's out of the realm. Let's go to 30%, or let's go to my 35%. Values them at $637 a share. Let's say Facebook has become a mature company now, and the worst case scenario, 15%. So, I mean, if they do meet my pessimistic growth rate, I mean, they could be overvalued right now. But that's where I'm going to come down to my range here. It's a little bit funky how I calculate. Basically, it's between my optimistic and pessimistic guesstimation. So I say best case scenario, Facebook is $637 a share intrinsic value. Worst case scenario, if it grows at only 15% net income the next 10 years, I'd say $161. I mean, I don't see it. I don't see it growing that slow. So another thing, I don't use this in the valuation, but I use this into considering investing in the company or not. I mean, look at this current ratio. That's ridiculous. I've never seen one that high. Current assets. I'll just double click in. They have current assets of $65 billion. Current liabilities of $3 billion. It's almost, I can't even hardly say that with a straight face. I mean, that's just, I've never seen anything like that. So that's pretty impressive. And since they have no inventory, the quick ratio is going to be the same thing as the current ratio. Tangible book value per share, $20. Let's say $20, and you're paying $287 for it right now. What is that? 200 divided by 20 would be 10. Let's see what the price per earnings would be for that. Price to book ratio, tangible book ratio, 15. Okay. Oh yeah, because we're close to 300. Okay, my math is not good today. That's why I check stuff. Well, that's not bad for a tech company, at least. Especially when you look at the debt to equity. That's unheard of for a tech company, 14%. And these are different formulas, but by coincidence, another metric I look at that I made up is intangible assets and goodwill all over total assets, because I don't consider those. I feel like a balance sheet's really inflated if it's over like 25% of their assets are intangible stuff, or what they overpaid for a company being goodwill. I'm not really gonna. That's almost a non-negotiable for me. So this one's down to 14%, so I'm cool with that. Free cash flow per share is $6.33. So they can do whatever they want. That's a total extra. That's the average for the past 3 years, by the way. And they can do whatever they want with that. So that's my valuation range, 161 through 637, depending on. I think you're safe buying anywhere in that range, but the closer you can get to 161, the better off, the less risk you're taking. Some people, let's just out of curiosity, use an 8% discount rate. $2.99 would be my minimum, and you get up to $1,200 doing that. So if all you had to do is change your discount rate, you could get it to what did I have it down here as 300 to 1300. So I'm not comfortable enough doing that right now with as highly valued as the stock market is right now, but some people might certainly still use that discount rate as well. So hopefully this helps you make a decision if you're looking at Facebook or not. I think it's a great company. I don't have any personally, but if I had some extra cash, then sure. I don't think you can. I think with the way this price is and my range, I really don't think you could go wrong. Even you might lose a little bit of money in the short term if we have another correction or whatnot, but long term, I think it's a pretty safe bet.